He was pretty clear that he thought that he had become a distraction, in his words, and that the company was better off in reinventing itself and moving forward under a new CEO. And then working with the board decided that that person should come from the outside. I would say, though, that this was his last quarter as the CEO of Wells Fargo, and you mentioned that we had a beat versus analyst expectations, but it was a quarter of producing almost $6 billion worth of net income, a lot of customer activity, customer feedback in terms of their experience in our branches is at 3-year highs. Things are actually going really well on the ground with the company as it relates to how we face off with customers and how we generate income. And that's a testament to the leadership that he brought to the company. But in his view, he had become a distraction, and it was time for somebody from the outside to lead the company going forward.
Well, the quarter might have been all right, but the guidance clearly wasn't. The share price down. I'm not sure I would necessarily be celebrating on a day of 3% decline. Anyway, back to the issue of Mr. Sloan. I mean, how is morale at the company following what is another big moment and a big negative moment in terms of trying to shake off the issues of the past?
Yeah, I think morale's good. I think Tim having resigned and essentially made a sacrifice so that the company can move forward, while people will miss him, is good for the company because it allows people to focus on the work that needs to be done. It's a real gesture about the fact that some things need to be different in terms of how we meet the expectations both of ourselves and our regulators around things like operational risk and compliance, which are the source of some of the contention over time. You may have seen that we just got awarded in the last week. We're among the top 25 of sought-after companies for people coming from the outside. We've had some great additions of talent to our team. Our attrition's actually quite low, and so altogether, I'd say as a reflection, I think there's definitely a headwind, but people feel pretty good about working for Wells Fargo. And it helps that the results have been as steady as the results have during this period, notwithstanding our forecast for net interest income, as you mentioned.
People may feel good about working there, but I don't know if they're going to be feeling good about taking that CEO spot, John. I mean, there's a New York Times headline that reads, Wells Fargo CEO could be banking's worst job. It's open. How long do you think this is going to take, and how hard is it going to be?
It's really hard to say. The board, it's any board's first responsibility to attract and retain who they believe is the best CEO. And they've set about doing that. They've established a committee. The committee has engaged somebody from the outside, and they're underway. It's been a couple weeks, and so we'll hear from them from time to time, I assume, as that process unfolds. And I have no doubt that they'll be able to attract a top-quality talent to the role.
John, let's talk about that guidance on the net interest income, which clearly
Sure.
was different from the likes of JP Morgan and PNC today. I mean, you only set the guidance in January, and on the call a few weeks back when Tim announced that he was retiring, he said there's no surprise financial information to come, and you reiterated other aspects of the guidance very loudly and clearly, like cost cutting, and didn't mention this. So what's happened?
Yeah, well, the guidance that we gave today overlaps with the guidance we'd been talking about. Now that the yield curve has moved down and stayed down the way that it has, at the end of the year we had a risk off both in the equity markets and in bonds, and bonds have stayed there. We make a lot of net interest income by reinvesting in our bond portfolio, and we're probably 100 basis points down from where we were in the fourth quarter, and the temporary nature of that, or the possibility of that being more temporary seems like it's off the table, and so we understand that we'll be reinvesting in a flatter and lower yield curve environment. That's a piece of it. There's also the question of what happens with deposit prices this year, the deposit costs as we complete the Fed's cycle of hikes is something that different banks will experience differently. We've maintained very low deposit costs through this reversal of Fed policy, and we model and estimate that deposit costs might continue to increase. On our call today, there were some investors who assumed we're being a little bit conservative there, and maybe we are, in which case we'll outperform the guidance. But that's a possibility. We want to let people know that. So we said down 2% to 5%. Previously, we had said it might be down as much as 2%, and so whether it's down 2, 3, or 4 will depend on a handful of things, like what happens with industry loan growth, where the shape of the yield curve goes, what the slope of the yield curve is, and what happens with deposit prices. Those are among the things that are driving it. And it's a little bit different than what we heard from other people, but we'll see with the passage of each quarter how people perform versus their guidance.
I guess that is the confusion, because it is different from other people, and you're all dealing with the same yield curve. I guess one area of difference in the past quarter and the past couple of quarters has been loan growth. Yours linked quarter over quarter was broad-based declines. Commercial loans, consumer loans, mortgages, home equity, credit cards, and auto all fell. What do you think's going wrong there that isn't going wrong with some of your competitors?
Sure. Well, so there's a few different things at play. One of them is we've continued to sell down pre-crisis mortgage loans that we acquired when we merged with Wachovia 10 years ago. We're very late in this credit cycle. There's a very strong bid for those loans. And so over the past few quarters, we've been selling them, which has an impact on net loan growth overall. On the other side, we've been adding almost equally with newly originated jumbo mortgage loans. We're the largest in that space, and those sit on our balance sheet. In our auto business, we've been shrinking it for a couple years. We're right now on the verge of growing it again. We completely restructured it, and while we did that, we took our foot off the gas a little bit with respect to growth. And the anticipation that we shared with investors today is whether it's this quarter or next quarter, that balance should begin to grow again. Credit cards are just seasonally down because people pay down their credit card in the first quarter, their credit card debt in the first quarter, after running up credit card receivables in the fourth quarter. That's a natural phenomenon. And then across the broad array of C&I loans, of different types of business loans, there are different things afoot, but we've got great growth in a handful of our businesses, and other businesses are more cyclical. As capital markets are open, balances will run down. In the fourth quarter, capital markets were more closed and balances ran up. So, you know, we're all the product of the mix of types of loans that we have, and we're probably among the last firms to still be running off non-core assets from the financial crisis, which at this point in the cycle has an impact on the overall growth rate and an impact on that net interest income calculation I gave, because those tend to be higher yielding assets as well.